Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I was scrolling through the comments section, reading a lot of your guys' comments, trying to respond to a lot of them. I might not respond to all of them because there's a lot, and thank you for commenting. One of the comments says, we must understand that when assets rise in value, that means the currency is declining in purchasing power. World's reserve currency status or not. I'm going to disagree with that statement, not in its entirety, but a portion of it. Assets can rise in value against other assets and against the currency. So yes, inflation will rise everything up. The ratios, when they go like this, when one moves against the other, you're actually increasing your purchasing power of the asset that's increasing in value. It's actually increasing in value against other assets. So the only way that you can make money, this is the only way. There is no other way to increase your purchasing power gains. This is the only way, is if you buy an asset that outperforms another asset. If you're in the asset that performs the least, that means you can buy less of the other assets. Hopefully that makes sense. So if you have a ratio that's really low and this one's very high, you have to have them rotate. And if they rotate, that means that the asset you bought can buy more of other assets. The dollar value is irrelevant, if that makes sense, because you can have the dollar go down, your asset go up in dollar value, in dollar price, but it doesn't gain as fast as the other assets, which means you're losing purchasing power by being in that asset, even though you're making, quote, money on it. You have to buy more of other things for it to be worthwhile investment. And that's why gold's so good. You can make money in a deflation. If all the assets go down at a faster rate than this asset, you actually win. Even though your dollar value, your price may go down a little bit. And that's actually a preferable scenario. I held a lot of gold in that crash in COVID. And I had more gold then, and I swapped some of my gold to platinum because platinum crashed far greater against gold. And now I'm holding a lot more platinum than I did back then. So you're looking at ratios, and the movement of assets against each other is how you make purchasing power gains. I don't know of another way of doing it outside of a company just absolutely killing it against all the other assets. And hopefully that makes sense to everybody. Now there's another person who had a question here. It says, Andy, can you please comment on Fred personal consumption expenditures, durable goods? Since pre-pandemic, it's up about 35%. Trend says it should have been up only 10. If people have already overspent so much on durable goods, this spending can go down in the next 1 or 2 years and return to the trend line. Has this spending been a driver for commodity prices? I'm going to say no. It's not a driver. The biggest driver of commodities is the dollar. It's inflation. And that's why I tie everything to real estate. Real estate is the driver of inflation through fractional reserve lending. Money goes into the commercial banks. Fractional reserve lending is when money gets lended from the banks, commercial banks, into, we'll call it the public, or out of those banks. 99% of the money supply comes from commercial banking and the loaning of those of that money. Over 60% of commercial bank loans come from residential real estate. Therefore, the majority of our money supply comes from residential real estate and the values of real estate. And if you're in an expansion phase of real estate, which means you're creating more homes at a faster pace above average and selling homes with loans attached to them, that loan is inflationary because it's going against a brand new home, a brand new asset in its entirety. So that is where inflation comes from. That is the driver of the commodity price in a commodity bull market. There is supply-demand characteristics, and it may be tied with the housing starts, with building new homes. It needs more copper, burns more fuel to do all this stuff. There's all these other tertiary effects around the world, and it also will change the preference of people and investors and countries. A country will be less willing to buy, let's say, bonds in America if it has a real negative rate, which means inflation's going up and interest rates are lagging. It creates a real negative rate. A country like China might say, well, there's no point in buying bonds. It has a real negative rate. Therefore, I'll just go buy commodities. And then everybody says, China's buying commodities. They caused this boom. Well, essentially, what you could say potentially is that China didn't cause the boom. They were reacting to something. They were reacting to real estate land values in the United States, which was causing inflation. Inflation caused an increase of interest rates. The increase of interest rates caused a real negative rate. The inflation interest rate, we'll call it that relationship. When you have a real negative rate, people sell bonds. Bond prices go down. And when bond prices go down and interest rates go up, people want to sell stocks with high PE ratios eventually. Depending at some point, they're going to sell those, and they're going to be more enticed to buy newer bonds at higher interest rates or go into commodities. So it spurs a whole bunch of human actions that are different than before with the declining dollar and inflation, and then the corresponding interest rates in reaction to inflation because of the real negative rate that is driven. In real negative rates, commodities do well, gold and silver do well, and all those things. So really, in my opinion, gold really does well only in a real negative rate environment. And that's usually an increasing inflationary environment going forward. And then interest rates try to chase it higher. That's the way that I view this. If you guys have any other questions, please put it in the comment section. Like to hear your guys' opinion. And thank you for listening. This is Finding Value.